Hello, we're here, Jennifer and
Jennifer
with Security National Mortgage Company, and we just wanted to talk about some stuff we've been thinking about. And you know, Jen, this morning I was driving around and I was thinking what happens to the people that didn't refinance when rates were really low?
Right.
And you know, how do they get money out to pay down some of these debts that are maybe even credit cards that have a high interest rate of saving 20%, and they have $20,000, maybe more, you know, in debt? And what kind of programs are available to them, or do they just keep getting further in debt as these rates go up?
Right. Yeah, no, that's a good question. And I think it's awesome that we have so many programs that are out there to help our clients. And one that did just come out actually this week is the standalone second product. So it can definitely help with refinancing that debt. So do you remember some of the features that were on
Well,
that?
I know the minimum that you can borrow is $20,000. So that'd be great. You know, anybody that has that kind of credit card debt or any debt, you know, or
Right.
more.
And it goes all the way up to $500,000 as a standalone second.
Yes. And so what that means too is, say you already have a mortgage and your first mortgage has a great low interest rate. What you would do is take out a second mortgage, keep your first one, but the second mortgage would just be to use towards that debt that you have. So then you would be paying a lower interest rate on the same debt you have, and then essentially you'd pay that off a lot faster than if you had the credit card debt that you know, initially started with.
Yeah. And the good thing about standalone seconds is that you are just using you're utilizing the standalone second. So if you have a first mortgage and you just love the rate and you don't want to touch that first mortgage, this is a different option, because previously there were only loan options to refinance the entire first loan, and you would have to consider a different interest rate. And with the standalone second option, you don't even have to refinance the first loan. It can just stay as it is, and the second loan can subordinate to that first. So it really does allow more flexibility.
Definitely, because let's face it, who wants to refinance if they got in, say, in the threes,
Right.
and
exactly.
refinance just to get their debt paid down? It kind of doesn't make sense. So it's a great option for people that have the debt, have the mortgage, but don't want to refinance the full rate, but they can get a second with, you know, a lower rate than their other bills. So
Exactly.
that's great.
Yeah.
Well, so give us a call, you know, Jennifer Newton at securitynational.com, or sorry, Jennifer.Newton at securitynational.com.
And I'm Jennifer.Asuncion at securitynational.com.
Thanks so much.